Welcome to the Wealth Under Pressure podcast. Financial success very often has less to do with owning a financial product, earning a high income, or even being frugal. Instead, the path to success comes from having a comprehensive plan that enables you to optimize decisions and avoid mistakes. Join John Smallwood, a certified financial planner, as he identifies key areas of pressure on people's wealth and strategizes to reduce it. It's time to liberate your wealth.
Hello and welcome to another podcast with John Smallwood. At the end of the last podcast, John and I were talking about how this was going to be an expansion. We were going to take all of the variations of life insurance and really dive deeply into each of them. We said it was going to be about a 5-part series, and as we're talking, it might be a little bit more. But today we're going to talk about the most widely talked about type of life insurance, the most controversial, in my opinion, type of life insurance, and the type of life insurance that if you don't own, you're crazy. Is that a fair statement, John?
Relatively fair.
Well, I figured I'd start this as a sensational podcast and see where you take it. So let's talk about term life insurance.
Exactly. So let's just step back for a second. And what we're talking about is, in the last podcast, was ensuring your most important asset. I just want to come back to that and make sure that we're all in agreement that the most important asset that I own is my ability to work, your ability to work, everybody that's listening to this, your ability to produce income and assets and save money is your most valuable asset. Without you getting up, going to work, putting in the 40-hour week, etc., nothing else occurs. You have to do that first. Now, if you're retired, it's different because now you're living off of pension income, Social Security, and other asset income, and life insurance still has an application to that. We're going to deal with that in a later time frame, okay? Life insurance in retirement. But one of the things that we want to think about is how do we use the life insurance during the accumulation phase? How do we prepare ourselves for life insurance in retirement? And then that passing it on to our family, a stage, okay, which is in essence would be considered the distribution phase in many eyes. Mm-hmm. So step back for a second. Life insurance, I like to think of it as dollars that are delivered in the future when I'm no longer here to replace everything that all the future obligations, liabilities, the dreams that I have set forth for my children, my family, my wife, so that they continue to operate as they do as if I were here. And that's the way I view the life insurance. So I'm married. I have 4 kids. One child just graduated college. But 15 years ago, I was in a much different position in my life. And if I had passed away, everything that has occurred over the last 15 years, I would have wanted that to happen for my family. And in essence, life insurance is a certain amount of capital that's supposed to come in that's going to replace the income back to the family, pay off our debts, pay off all these things. So we have to think of it as a replacement to the human capital, which is its ability to earn income. Just want to put that out there.
Okay.
So term insurance is, in essence, like it sounds, it's a life insurance policy that is considered to be the cheapest way to own life insurance, the least expensive methodology to buy insurance because it's not permanent. It's for a specific term or a specific time frame. Okay? Make sense?
Yep, I'm right here with you.
Okay, good. Just want to make sure that I haven't lost the listeners here today.
Well, and it'd be even worse if you lost the host. But yeah, keep going.
I lost the host, and if you're sleeping, we need to wake up now. Okay. So the life insurance is term life insurance is in essence a rental. I'm renting the coverage for a specific period of time. I can purchase a 10-year level term. I can purchase yearly. Let's start off with this. I can purchase yearly renewable term, which means the premium will increase every single year, and it could be here to age 95. It could be here for only a 10-year period. It depends on the company that is issuing that contract. If you look at your term insurance that you may or may not own, if you have policies that are old, they're probably yearly renewable term, because 28 to 30 years ago, that is what people purchased in the industry. And what's come out now is you have 10-year, 15-year, 20-year, 25-year, 30-year level term insurance. So what does that mean? I can buy a certain amount of insurance for a 10-year period, and the premium is guaranteed to be level for the 10-year period. And at the end of the 10 years, that premium will go up exponentially, which we'll talk about as we move forward here.
Okay.
If I buy 15 years, that means the premium is level for 15 years. 20 years is level for 20 years. 30 years, it's level for 30 years. Now, some of it's guaranteed to be level for the full time. Some of it's not. So when you get online and you start looking at policy options and things, you have to make sure that you're looking at apples to apples comparisons. And we'll make a list as we go forward as to, a checklist of things that I should be considering when I am purchasing term insurance, either online or with an advisor. Okay. But I want to put this in context for a second to kind of draw a comparison out that I picked a person who has a April 8th, 1978 birthday, and that makes the person 40 years old. Okay, so I figured the conversation would be better if we just said, let's just use some numbers so people get an idea. So 10-year, I'm going to buy $1 million of coverage. The premium will be level for 10 years. And the yearly premium to insure that $1 million is either $29 a month or $335 a year. I like to look at it as an annual cost. All right, so it's $335 a year for a 10-year level. As a comparison, the 15 is $405 for the same $1 million, but it's level for the 15 years. A 20-year level term is $595, and a 30-year term is $1,154 per year. Now, what I did is on our website, we have a little comparison tool that goes out and it shops, all major carriers, and I just ran this, okay? There are nuances that you need to understand with each contract. I don't want to hit that immediately now. I want to talk about this from a cost perspective. So what we're doing is the term insurance is in essence a rental for a time frame. And the idea that we've all been taught is that we don't need life insurance in the future when our debts are paid for and our kids are out of college and we're in retirement. And as we said in the last podcast, it's probably one of the biggest false statements in the financial planning industry is that concept. If you remember in one of the earlier podcasts, I don't remember which number it was, we talked about the 5 rules of the financial institutions. Do you remember that one?
Yep.
All right. So that if the institutions get us to follow the 5 rules, then they're going to be successful. And I question whether or not we're going to be successful. So if you remember the first rule, it's to make us comfortable with the company that we're going to give money. Now, in this particular case, if I go online and I shop, I might be shopping based on price comparison, right? So I find a really good, 20-year term that's going to cost $595 a year. So the first rule is I feel good because they have a great price. Now, the second rule is that we need to give the financial institution money on a systematic basis. So if I'm going to do a 10-year, 15, 20 years, 25, 30, which one's better for the insurance company? The longer it is, the longer you pay, the better off it is for the insurance company.
Okay.
The third piece is a financial institution. When you're looking at compounding of wealth and other things, they need to hang on to your money for a very long period of time. We're going to talk about that in a second. And when you go to give your money, when you go to get a distribution of your money, they want to give you back as little as they possibly can. That's going to be the fourth rule. And the fifth rule is they have the ability to transfer the risk from yourself, from themselves as an insurance company to the insured. Okay. And so if you think about term insurance for a second and those 5 rules, I buy the policy because it's got a good rating, it's got a long history, it's a great company, et cetera, et cetera. All the marketing makes me feel good. I pay a low price. I give them that policy for 10, 15, 20, 30 years. I make that decision. And in term insurance, when I say I'm going to buy the 20-year term policy, I'm going to pay $595 for 20 years. If I don't die, what's going to happen? Do I get any of my money back?
No, you're renting.
So I rented. And at that moment, the asset that I was renting, which was the $1 million policy, is now gone. So the insurance company now does not have to give me any of that capital back that I paid in. And the risk is now been transferred to my family, but also, depending upon the company that I'm implementing the term insurance with, if I'm buying a 30-year policy, the premiums may only be guaranteed for 15 years. So the insurance company may turn around and say, oh, we guaranteed the policy for 15 years, even though you bought a 30-year, and in the 16th year, we had poor, lousy claims experience. By contract, we can raise the rate on you. And you need to look at this. You need to dig in, okay? But one of the things that I want you to really think about is the 5 rules of the institution are alive and well within term insurance, because if I'm 40 years old and I own a policy for 10, 20, or 30 years, that gets me to 60 or 70 years old, right?
Mm-hmm.
I drop the life insurance coverage, and the insurance company has a party. I paid for 20 years, I didn't die, and now they don't have to pay out the $1 million. The financial institution is extremely successful. They have the use of my money, and they don't have to give me any of my money back. And the mindset is you can invest the money elsewhere rather than buy permanent insurance, which would be a universal life or a whole life insurance policy or a fixed index universal life or a variable. Those are considered permanent. I can invest the money and make more money over time. We'll talk about that later. So term insurance is a rental. There's a very important variable that is on many, many contracts, which is called conversion option. So when I buy a term life insurance policy, I may have the right to convert that policy to a permanent policy without evidence of insurability. So one of the things that we recommend to our clients is that they get maxed out very early, very young. They buy the max amount of coverage that they can do. So when you talk about maximum, each insurance company has a different perspective on what maximum is, but they're all relatively in the same boat. And you have to think about it as you and I each have an economic value. Our economic value is based upon our income and our assets, right? And that's a distinction here, right? Is that there's human life value and there's economic value. Well, economic value is how much revenue and income does something provide that provides it with an economic value. Mother Teresa had no income, but her human life value was, she touched everybody, right? It was wonderful, but she had no economic value. I just want to make a distinction between human life value and economic value. So this is a dollars and cents kind of concept. So the maximum amount of insurance is a function of income. So if you have a 40-year-old who's making $100,000 a year, the maximum amount of coverage is approximately somewhere between 20 and 25 times earnings. Conventional wisdom tells us that we're going to need, to buy what, 10 times, right?
Yeah.
So 10 to 15 times, but the maximum amount is 20 to 25 times. So a person making $100,000 who's 40 years old could buy somewhere between $2 and $2.5 million of total life insurance coverage. Okay.
Mm-hmm.
So I buy this. If I buy 10 times, and you have to think about this in units for a second. Okay. And the units is every $1 million that I get, what do I want my family to do with that? I want them to be safe and conservative with that. So I'm going to put that in an investment. And if my spouse is 40 years old, maybe she can take $30,000, $40,000 a year off that $1 million without running out of capital. We talked about distribution rates before. So if I bought $1 million of coverage and I'm making $100,000, it's 10 times is what conventional wisdom says. I was making 100. Now my family's going to live on 30,000. That doesn't make any sense.
It seems like they'd be quite short.
They'd be quite short. And if they pay off the mortgage and they put some money aside for the kids' colleges, there's no money. Okay. So what we're talking about is, if I had $2.5 million on that same person making $100,000, they get the income, they get this income tax free, and I get that 3 or 4% income. They're now going to get $75,000, which could be tax free depending upon how you're investing, or tax advantage. It's getting close to where the family was. And the purpose of the life insurance is not to make the family rich. It's to keep them where they were. And, from a planning perspective, that's the number one goal. So what I say to everybody, regardless of their age, but the younger you are, the more important this is. Get the maximum amount of insurance with a great company that's convertible. What does that mean? What we know is that our health is going to change over time. We may get healthier, we may become unhealthier, but we all know people that have become uninsurable in their lifetimes. Okay. So if I bought a 20-year level term policy today and I'm super preferred, I got the top rating, and I experience some sort of accident or I get some kind of illness or sickness, I'm no longer insurable. So I want my life insurance now to be convertible to a permanent policy. A lot of the policies that I see people buying online, they're not convertible. They may only be convertible for 5 years. And then you have to ask the question, with the company that I'm buying that's the dirt cheap term insurance online or from an advisor, is the policy convertible? Oh, yes, it is. But to what? Is it a good policy? Would you buy that policy on the open market today, or is it not a good policy? So conversion becomes a key point, and maximum coverage becomes a more important coverage or a more important point, because it doesn't matter the type of insurance I have if I died yesterday. What matters today is there's the maximum amount of monies there available for my family to get through the crisis. At least I like to think it's a crisis that I am gone.
John, do you mind if we I want to back up just a smidge here, because
Sure.
You used a term that I don't know if you've defined clearly enough, which would be what do you mean by super preferred? Can you break that down a little bit? Because obviously that's going to play a much larger part in the other types of insurance we talk about.
Right. So there's a concept that's called rating, okay? And the insurance companies, they get a competitive advantage because before you buy the coverage, they make you pee in a cup and take blood and ask you a bunch of medical questions. And I'm quoting on this conversation when I'm saying 20 years is going to cost $595, I'm assuming it's a preferred plus or a super preferred. So each company has their own vernacular, but the idea is that you have a best class, a second best class that might be considered preferred, then you might have a select, then you might have standard, and then you have what's called table ratings. And the table ratings could be a table A, B, C, D, E, F, G, and then decline. And what that basically means is a table A rating might be a 25 or 30 or 40% increase over the standard rates. And a table C might be 150% increase over the normal rates because you have some sort of condition that the insurance company perceives is going to change. So now that cost is kind of interesting because the cost really could dramatically drive up if I do that same $1 million coverage for the 10-year coverage. Instead of being $335, it could cost $735 just from going from the best class to the fourth class. And this is why what I'm saying is by locking in your insurability, you could lock in your super or best in class rating. Really important.
And when you lock that in at a younger age, right, doesn't that help too?
Oh, you lock it in at a younger age, so the premium is cheaper.
Yeah.
And when I convert to a permanent policy, I'm going to get that super preferred or that best class rating. So that policy will be priced well when I convert in the future also.
Got it. Well, thank you for that clarification. That's awesome.
Yeah. And most of the, you have to think about this is, let's say I buy the $2.5 million and I do it at super preferred. The company that I bought that with, that conversion option might be, if I buy a 10-year level policy, I might be able to convert it for 10 years. If I buy it for 15, I might be able to convert it for the 15 years. Or if I buy the 20, I might be able to convert it for the 20 years. It really depends on the company. So this is generic. We're not talking about any specific company. But the idea is that I have that conversion option for a full 20-year period. We all know what could happen to our health over a 20-year period. So that locking in of the best class. Now, if I buy a policy and I don't have the best rate class because I smoke or something is wrong, I'm going to pay a higher premium. I could lock in the rate and with most companies go back and renegotiate it without losing that rate. That's called a term rewrite. Okay. So this is something that the rating is super important. The conversion option is super important. The proper amount of life insurance is unbelievably important to the long-term plan. Because if you think about it, when you were 30 years old and you were newly married, how much were you making and what was the amount of life insurance that you had? It wasn't as much as you were making today, hopefully.
Sure.
And the life insurance need was a lot less. My wife and I got married. We had no kids. We didn't have anything. A couple of years later, we had 4 kids, mortgages, houses, businesses, business partners, etc. Term insurance, there's not a lot of people that can afford 100% of their coverage to be permanent. Term insurance is part of an overall strategy, and you have to look at what are we trying to achieve. Once all my kids are out of college, that college need, that unfunded college liability, I might have saved a certain amount of money at a certain point, but I'm underfunded on my 14-year-old girl if I wasn't funding the money into it going forward, right? So the life insurance will fill that gap. But once she's out of college and that expense is all taken care of, that life insurance now, do I need it for income replacement for my wife? I don't know. It depends upon what has happened. I don't know the future. But I do know this is the max amount of life insurance needs to be in place at every stage of my life. My father had a great term always. He's still here, but he had a great term when he was working and he was active, was that dying is bad enough, but dying in a down market really stinks. Okay? Because things are less valuable in a down market, and sometimes people have to sell things in a crisis if they don't have liquidity. Life insurance is a definitive guarantee of liquidity that comes in at a future date. The question is we don't know the time, date, or location. Okay? Mm-hmm. So kind of bringing this back a bit, right? So if I'm going to make a lifetime commitment to an insurance company, the quality of that company and their ability to pay is super important, right? Having a policy that's convertible to a permanent policy is really important. Having a premium that I can lock in for different time periods is important. So you think about it. You have different things that are going on in your life. You might start off with more term insurance. You might start off with longer term insurance because it's expensive. But when you're in your 50s, you might say, I need 10-year term to get through a business transaction, or I might need it for obligations for colleges, or there's many different reasons, right? And we'll have a podcast dedicated to talking about all the potential uses for life insurance. I just wanted to stay on the term insurance concept today because the perception, and this is something that I don't think people really understand, is that if I buy term insurance and I hold it for a 20-year time frame, and let's say I'm doing that $595 a year policy for the 20 years. I do that 20 years. I've spent.
I was wondering if you were doing math there, John. I'm like, what is he actually doing the math right now?
I'm doing the math because it's $11,900 in premiums.
Okay.
So one of the things that we've always talked about is financial pressure and opportunity cost, right? So if I do this, and this is something that I want you to understand, is that if I did this for 20 years and I dropped the coverage, not only have I lost the $11,900 in premiums, which seems like not a lot of money, but I've also lost the ability to invest that. Assume I could get 8% for the 20 years for a second, just arbitrarily pulling it out of thin air. That would have been worth $27,000 if I had taken it and I invested it somewhere else. Now, if I live to life expectancy, let's say I was 40 and I go to 60, and I now live another 25 years to age 85, and that same 8% compounding is there, that's now $186,000 of wealth that I've transferred to the insurance company. And then you think about the death benefit, right? How many people get to retirement and their term insurance, for example, I just ran a company here where the premium is $635 a year for 20 years for $1 million on an age 40-year-old. I could get the full illustration. And I get to the end of the 20 years, I didn't convert the policy, and I'm uninsurable. What happens is it goes into a yearly renewable term rate. So now that premium, I get a bill in the mail for $17,925. Can I pay it? Am I uninsurable? Can I go out and pee in a cup again and take blood? I don't know, but I may have to do that. If I'm not insurable, I'm writing the check for $17,925. Next year, the bill is $19,925. Then it's $22,365. And by the time I was 74 years old, the premium's up to $65,000. So the insurance company, just putting this in the right perspective, right? The insurance company's mission is to get me off the books before I walk off the face of the earth. So if I hold the term insurance from now to 60, and I take my wife out to dinner, and I tell her, we've had a great 40-year marriage, etc., and I just want to tell you that I love you so much. Everything's been wonderful, but I'm going to drop my $1 million life insurance policy because we've accumulated enough money, and I think we're going to be okay. And most people go, oh, yeah, that's fine. And then I die 2 days later after dropping it, which happens, right?
Yep.
And what has my family now lost? Not only the $186,000, but if they didn't need the money because I was successful in accumulating all this money, so my wife could have gotten $1 million if I paid an extra premium.
Right. Put
that to work at 8% for 25 years. That has cost my family $6.8 million.
Yeah, and that's where the numbers really, really start adding up and making a lot of sense. All right, final thoughts on term insurance before we prepare for the next podcast.
All right. So here's the takeaway. Most people listening to the podcast need life insurance. If you're young and you're starting a family, you're 10 years from retirement, you're 15 years from retirement, you have to understand what's going on in your financial plan. You might have a pension that you think you're going to get, that your family's going to get. It's in life-only mode for a lot of people. If you die, that pension goes away. So you really have to understand how much life insurance do you need. You need to sit with a professional and determine how much life insurance should I own and where should it be owned. There's a whole bunch of questions. Term insurance. If I'm going to buy term insurance, what's the quality of the company? What rating am I going to get from that insurance company? And different ratings are going to happen for different things with different insurance companies. So sometimes it's important to shop with multiple companies. Is the policy convertible to a permanent policy? And if so, what are the current policies that are available? Would I want them? A lot of times you're going to find that you wouldn't want them when you do a comparison. Okay? And you also want to look at some of the riders. We didn't get into the riders. We will be talking about this at a future date, but there are riders such as waiver of premium. And I see a lot of people out there on the internet talking about you would never want a waiver of premium. Well, what the heck is a waiver of premium? If I become disabled yesterday and I have term insurance, the company will pay the premium for as long as I am disabled. Now, which means I don't have to worry about it. My spouse doesn't have to worry about it. If the policy is convertible, a lot of companies will convert it to a permanent policy, so the policy's here forever. We're going to talk intently on a future thing. But this is one of the most important parts of your entire financial plan, which is protecting the most valuable asset in the plan, which is you. And if I want to replace the income and the future obligations and the future dreams and the future things that I have for my family. So we go through this checklist. We assess what you need, all your opportunities, all your liabilities, which we do in our wealth curve pressure identifier. We talk about the type of insurance that you want to have, the quality of the company, what's the best rating that we can get you. You know, my team is going to coach you on how to get the best rating. We're going to spend time to understand, are you taking medication? Are you on this? Each company is going to be a little bit different. Is it convertible? And what kind of other riders can I put on that contract to protect me, such as waiver of premium? There are some other ones we will talk about. But this is just know that this decision is probably one of the most important decisions in your financial plan, and you need to spend some time on it.
And you definitely need to sit down and talk to somebody like you, because depending on the company, those riders can be crazy complex. And we really want to make sure that you truly understand what is in the insurance contract that you're signing. And if you are listening to the podcast and you're scratching your head a little bit wondering, how does this, what do I really have? Man, take a moment, give Smallwood & Associates a call, just try to sit down and get some of their time, because John, on your website, they can schedule some time with you, can't they?
They can schedule some time. We actually have a little widget on the website that can actually go out and shop coverage out there. You can get prices. It's on our website. But my position is, whether you buy it online or you buy it from an advisor, the costs are the same. It's the prep and how you approach it. I think that's going to make a difference. And then how you own it, whether you have the right type and where you own it. Should it be in a trust? Should it not be in a trust? There's a whole bunch of other things that are going on. It's not simply just buying a life insurance policy. And I think that's what I want to focus on, is that term insurance potentially is the greatest thing ever, but it's a short-term problem to a long-term need.
Gotcha. Now,
everybody listening to this podcast is going to die. We just don't know the time, date, or location.
Right. So I think as we continue to go through this series, John, I think we're going to find that 5-episode idea is going to expand, because now we have, you just brought up 2 other things. And I don't really know if we want to do these as separate podcasts or we want to do them as inclusive in some of the later ones, but we need to talk about riders, right? And we also need to talk about who owns it. And I would love to pick your brain on the who owns it, because there's a lot of different techniques that I've heard from other insurance advisors and financial planners on how and who owns what aspect of the policy for tax reasons, for all sorts of other reasons too. So we're going to button this puppy up today. So John, thank you. Thank you very much for educating our audience more on term insurance. Everybody and their brother needs to listen to this podcast. So if you have not shared, or if you're not subscribed to the podcast yet, please, please, please subscribe, and then make sure you share this with your friends and family, because this is a discussion that needs to happen. So for John Smallwood, this is Matt Halloran. We'll see you on the other side of the mic very soon.
Smallwood Wealth Management is a registered investment advisor. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as the receipt of or a substitute for personalized advice from Smallwood Wealth Management or from any other investment professional, and is not intended as an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives, and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation.